Have you noticed a pattern? That good investors make good businessmen as well. In fact, this view was voiced by Buffett when he said, "I am a better investor because I am a businessman, and a better businessman because I am an investor." Being an investor and a businessman are joined at the hip. Great investors know of all levers that actually drive the cash flows of a company. They understand how businesses work and how shareholders' value is created. No wonder this sets them up for success when they go on to build their own companies. There is one such businessman come investor whose story we are going to discuss today. But before we do that, make sure you subscribe to our channel so that the algorithm works in our favor. Mr. Radhakishan Damani is one such person. Born in 1954 to a Marwari family in Bikaner, he is one of the self-made billionaires of India who had humble beginnings. Fondly known as Mr. White and White, he started his career with a ball bearing trading business, post which he switched to investing in the 1980s. He had a wildly successful career as an investor, with even the big bull, late Mr. Rakesh Jhunjhunwala, counting him as his only guru. It is this deep understanding that he gained about business fundamentals and how return on equity is generated that helped him revolutionize how Indians shop from supermarkets and hypermarkets as he founded D-Mart in 2002. Before actually embarking on the journey of D-Mart, somewhere in 1997, he actually took the franchisee of Apna Bazaar, a cooperative departmental store chain, but wasn't convinced with their model. Rather, he was obsessed with the idea of discount format stores, for which he actually visited the stores of Walmart and Costco to gain a fair idea of the concept of value retail. And together with his co-promoter Ashok Maheshwari, they established their first store in Powai in May 2002. Despite playing an instrumental role in co-nurturing D-Mart, not many people know about Mr. Ashok Maheshwari. This is because he exited D-Mart very early, in 2006, when they had just 10 stores. Come to the present day, and D-Mart has become a household name for value-conscious Indians, which is over 90% of the Indian population. Following a cluster-based expansion strategy, it operates 284 stores across 10 states and 1 union territory with an 11.8 million square feet retail business area, with 50 stores coming in FY 21-22 alone. It has also created immense value for its shareholders with over 600% all-time return, which is an outlier when compared to its counterparts in this space, who have failed miserably. To quote an example, Future Retail, popularly known as Big Bazaar, which listed at around Rs 150 on bourses, currently trades as a penny stock. D-Mart has more than 4 times its revenues as 60% less operating expenses. Obviously, Mr. Damani has cracked the supermarket model with D-Mart, which nobody could. Let's uncover some business secrets and lessons by delving deeper into their operating landscape. First, around 80% Indians live hand to mouth. Consequently, they'll any day optimize for money rather than time. Damani understood this really well and made product cost as D-Mart's differentiator and ultimate selling point. While this might not look much at the face of it, this is what really matters to most Indians. They won't regret queuing up for 3 hours and a bad experience if they can get essentials cheap. But how did they actually crack the pricing game? Buying in bulk? Well, yes, but not the only reason. There are several layers to it. Let's understand them one by one, starting with slotting fees. What are slotting fees? These are the fees given by manufacturers to large multi-chain retail stores like D-Mart to showcase their products on its shelves. They know for a fact that such retail stores actually facilitate purchases in huge numbers, unlike roadside kirana stores, and so are more than willing to pay for a priority placement of their goods. D-Mart further used these slotting fees that it received from manufacturers to subsidize the product cost for consumers. This expanded sales volume. Okay, All this works well to defeat small kirana stores. But won't other big chains like Big Bazaar do this as well? Yes, you're absolutely right in thinking so. With an almost perfect competition and similar prices, the only way one can boost their margins is by keeping their costs low. And this is where D-Mart outplayed competition. Unlike other retail giants who followed a 90-day payment cycle, D-Mart took no more than 5 days to settle payments for manufacturers. As a result, manufacturers were more than willing to offer lower prices. Apart from this, they have a strong control on their operating expenses. If you look at D-Mart stores, they aren't extravagant, nor would you find a bunch of employees attending customers. It is this very reason that they enjoy industry-leading profit per square foot metric at over Rs 1,000. They also have the perfect retail assortment strategy, which deals with depth and the width of the product. They were the first ones to focus on the regional foods category, which drew them a lot of audience. They also ensured that they only sell items having a very high turnover. This naturally leads to less wastage and a better bargaining power for D-Mart to negotiate prices. It also enables instant cash flow generation, thus lessening the working capital cycle and need to take up debt, huge savings in terms of interest costs. They also save loads of rent cost. How? Well, they own around 80% of their entire store area. You may argue that this would have led to a huge upfront cost. Yes, back in 2002, when they started, their initial growth was slow. They didn't take up debt for expansion. Rather, they used cash flows from existing stores to fund others. Let's understand this using an example. Assume that operating cash flow of one store is equal to Rs 200 and the cost to set up a new store is 600. This means that the first store must operate for 3 years to actually set up the second one. Now with 2 stores, they just need 1.5 years to set up the third store. Finally, with 3 stores, they can set up the fourth one in just a year. This model set D-Mart up for a rapid future growth. Moreover, they targeted locations on the outskirts of major cities, knowing that it would do little to affect their business to buy land at cheap rates. These elements, when combined, ensured that D-Mart grows organically over the years. In fact, there's no year in the history of its operation where D-Mart wasn't profitable, both at an aggregate as well as a store level. Mr. Damani wanted to build a good, sustainable business from day one with utmost patience. He had no plans of matching up the status quo. It is due to this very reason that they IPO'd in 2017. 15 years after kicking off operations. All this while, Damani took time to understand customers, build partnerships and put in place operational efficiency to build one of the few wildly profitable consumer companies of India. If you're also someone who values sustainability rather than rapid growth, then you must have definitely found Mr. Damani's story very fascinating. What are some other business stories that you would like us to unveil? Let us know in the comments below.